You expected a hike and then a dovish outlook or dovish commentary. Is that what you got?
I think we got that in terms of the actual statement. I think what's happened is that the Fed is changing its forecast slowly. The market changed its forecast very quickly, and you've got this misalignment where the market wanted the Fed to move as quickly as it did to recognizing the weakness that's in the pipeline. And the Fed didn't, Powell didn't give them that. He sort of said, yeah, I'm taking a step towards you, but I'm not taking the 3 or 4 steps towards you that the market wanted. And that's the misalignment that we had.
All right, you're from that viewpoint. Julian, you own stocks, you help people buy stock. You're like, you just can't believe this happened, right? And didn't you think he was going to listen to either Kramer or Druckenmiller or Trump or somebody and say, look, there is anecdotal evidence that you don't need to do. You may do one for credibility, but then tell us that you're going to wait and see what happens. Don't you think that would have been a normal thing to do?
We, too, were very vocal in recommending heavily that the Fed not hike yesterday. Yeah. And actually, there is a positive this morning. The positive is in the currency markets. The dollar is substantially weaker. And to us, that is the first part of the message that says that yesterday may have been a bit of a knee-jerk reaction to the press conference, and that, in fact, the market may be, and we think the Fed, given the reaction, is reassessing the speed of things. And Dino hit on it. This is all about the speed of things. The problem with ignoring the consequences of the balance sheet reduction really tells you that the Fed is not paying attention to the fact that financial markets correct much more rapidly on the downside than they do in bull markets to the upside.
There is an inconsistency. I mean, if Jerome Powell is going to go out there and say, we will monitor developments and we're open to not, this forecast is open to new developments, data dependent, whatever you want to call it, and then saying, but the balance sheet program is automatic. There's going to be no change to that. How can you have tightening on one side that's data dependent, tightening on the other side, which is just automatic? Yeah, no, that's a good, it's a great point. So I think there's 2 things. One is he did acknowledge the tightening of financial conditions, right, which I thought was positive, but then he kind of sort of put it aside and said, but yeah, we recognize it, but we're not really going to react to it. The balance sheet, it was really surprising how he did dismiss that. He's just he was asked about it and he said it really doesn't really matter. That was the implication. And I don't see how you can do that given how it was played up as the balance sheet was being built up. It was going to have all of these impacts on markets. Positive on the way up, it's going to be negative on the way down, right? And on the way down, it's got no impact. And I think that, if I'm a market participant, and I think the Stan Druckenmiller article was was really pointing to that, was you can't just dismiss that. It's got to have an impact on the way down if it had an impact on the way up. All right. I got a number 6 here from Tepper. He says the Fed. Addendum. Yeah, addendum. This is watching. Yes. The Fed doesn't care about the stock market within 400 SPX points. 400 SPX points? Yeah, 400 SPX points. I care. No, I'm objective. Anyway, it's the, and then in quotation marks, it's the real. Can you ask him a question? It's the real economy, stupid. I don't know if he'll answer. I can. What do you want? Ask him what percent. He said cash is not bad. What percentage of his portfolio is in cash? Is he short? Because what we've seen, interestingly, is there's a lot of bearish sentiment in the market. But we've actually seen the amount of short interest in the market drop precipitously as we go into the end of the year. Right. What do you make of that? That's generalized deleveraging. Okay, we're going to close out at total position cutting. But when you look, it's the biggest drop since 2016, though. Right, but it has been a terrible year for hedge funds, and frankly, you are making money on some shorts, but you can't. It's really difficult to press stocks that are already down 25% and are discounting, in our view, a recession. We think now's the time that you want to start looking at those stocks, because the question is, when you think about the stock market a year from now, is there going to be a recession? Kevin talked about this a few moments ago. The earnings trajectory is still there. This was the peak year, but we're still going to get decent growth. The problem is the Fed needs to be cognizant of the fact that it influences confidence here, and that's where the tipping point is, and that's why stocks have not yet started to rally. Most institutional mandates for 2019 require returns of between 5 and 6%. You can't get 5 and 6% with cash. So after all the stuff we've gone through in the last 2 days, where do you deploy money to get 5 to 6% next year? Because that's what you have to do. That's why you're hired. That's why people pay you money to take risk. Well, so again, the message from the markets this morning
is that the dollar is weaker, meaning that, in our view, there's only one Fed rate hike next year. And in fact, thinking about it, we may be too high. So from that point of view, international markets look very interesting to us, very beaten up. We also think that if there isn't going to be a recession, some of these deep cyclicals, financials, and dare we say it, energy, look interesting.